A lot of housing predictions are coming out showing that next year is going to look a lot different than the last few years. And it's clear now housing is slowing. The bulls have completely retreated and they're coming up with excuses of this shortage that they said happened for years and years to pitch buyers to go out there and buy houses before it's too late, right? It's a marketing play. So let's dig into that, why that is not true, what's happening today, and a slew of economic data that came out over the last week. So number one is the existing home sales came out last Friday, and it showed that the median prices are starting to stall. They're only up 1.2%. Now, of course, this data is lagging. It takes time for it to come out, but you can see that where the prices are starting to slow are different depending on the region that they're in. Now, you have to understand that real estate is extremely micro. Even within certain cities, prices change based on their proximity to certain amenities, to new construction communities, things like that. So let's just look here in the South, it's only up 0.8%. In the West, it's actually fallen. In the Midwest, it's up 5.8%, which is strong. And in the Northeast, it's up 1.1%. And when you look at the accumulation of that, it's 1.2%. And you can see that there's definitely regional differences when we look at the housing market. Now, when you're looking at total existing homes sales, and this comes from the National Association of Realtors, we're just grinding along the bottom, right? Prior to this, we were almost up to 7 million existing home sales per year. And now we're all the way down to 4.13. And we could stay there for a while, though I will give you my prediction for next year is that we will see more existing home sales happen as sellers start to capitulate and let buyers buy their houses at lower prices. So I do think that lower prices and lower mortgage interest rates due to employment issues will cause there to be more transactions. So that might sound counterintuitive in some cases because if you don't have a job, obviously you can't purchase a house. However, I don't think it's going to be as widespread as people expect, but I do think that existing home sales will start to come back off of this bottom that we've been grinding here for the last few years since the Fed hiked interest rates. So look, when demand slows, you start to have the inventory come on. It starts to stack. This is Jacksonville, Florida. We had 2,000 active listings just 3 years ago, and now we have 12,000. And each month, there's more and more inventory. So real estate's an illiquid asset. It takes time for it to play out. It just builds until it basically becomes unrecognizable. So this type of shift that we're seeing on the ground here can take years to play out. I expect it to, my prediction is that it takes a little bit longer to play out, maybe 5 or 6 years for us to really see the market reset. I'm calling it the great exhale because we're at this balloon phase right now. We're in a bubble, but I don't think it's going to pop like it did before. I think it's just going to exhale and we're going to have to wait until wages come back up so people can start purchasing again. In the meantime, prices will come down and we'll see what happens with interest rates. It just depends on what the Fed decides to do next year. But in the meantime, number of sales are really hurting. Look at this. This is closed sales from November 2025. This comes from Calculated Risk blog that's put out. You can see, because you want to compare the numbers to what it was like pre-2020, because that's more of a normal market where the Fed wasn't intervening as much. You can see that Austin, Texas is down for number of closed sales, 15.9%. They're getting hammered. They're basically the epicenter of the bubble. They had all this tech relocation. They have massive number of new construction, a little bit overbuilt. The migration slowed. Look at Charlotte. And obviously we have the affordability crisis as well. Dallas is really struggling. 45.6% less closed sales in 2025 than it did in 2019. That's devastating for people who sell real estate, obviously. And in my market, you can see down here in Jacksonville, we're down 20%. Overall, it's looking like the market's a lot slower than it was before the 2020, crisis started. And this is to be expected, right? Prices went up way too much. People are unable to buy. The locals are completely priced out for their market. You have to wait for wages to come up or you have to wait for prices to come down. So when sales slow and the supply builds, prices come down. This is the next thing that we're seeing. This comes from realtor.com. This is their projections for what's going to happen in 2026. I went through their projections and I saw their projection for Jacksonville, Florida, a 6.9% decrease. My projection for before this report came out was 5 to 7%. Now, of course, Jacksonville is like 5 cities in one. So it depends on where you are. It depends how close you are to new construction because new construction is what is driving prices down. It's just completely overbuilt. They're throwing massive massive incentives out there to get buyers to fill homes, and that's where we're going to see the majority of the pain. But you can see there's some markets that are holding up just fine. Durham, Chapel Hill, like even in the same state, it's a little bit different. Greensboro is down 10.9%. That's their projection for next year. South Carolina down. But then there's some areas in Connecticut that they're projected to be up. So it is a supply and demand game next year and an affordability game. And we'll be digging into that data all along the year because it's going to be a fantastic transition year to track with a lot of really interesting information that's going to be coming out. And a lot of people are going to be exposed because as the tide comes out, we're going to be seeing what everybody has been up to. And the next issue that we're seeing out here is that employment is slowing. This is the next thing that could crack the housing market. And we've barely added any jobs since April. This comes from the BLS. You can start to see that we're just cutting jobs across the board. You may have heard a friend lose their job recently. The friends that are out there looking for a job, it's much harder to find a job. You might be hearing that college degrees aren't worth what the paper that they're printed on, and you're paying $80,000 to go get an education or even more in some cases. But ultimately, unemployment is now up to 4.6%, up from 4.1% in June, and it's expected to continue to rise. And that's why we saw a Fed rate cut just a couple weeks ago, because they're scared that unemployment could continue to rise and they have their dual mandate. The other issue is that we're seeing CPI come out. It came out at 2.7%. However, it was strongly manipulated for some various reasons, and the data continues to come out on why that is. And it's likely that inflation is actually a little bit higher, but the Fed needs to do whatever they can to continue to pump this economy, keep it going. They don't want to see any pain out there in the marketplace. But it's starting to show up. I mean, this is from Challenger Gray and Christmas. We're at 1.17 million layoffs announced just through November and 32,000 private sector job losses in November. So this is a 5-year high heading into 2026 with the number of layoffs that have been announced. And it's getting worse every single month the data comes out. So we're seeing housing data become worse. We see the employment data get worse every single month. And we see the price data get worse. And obviously, this is showing up in consumer sentiment. We're at great financial crisis levels of consumer sentiment. This is the University of Michigan report that comes out, and sentiment drives markets, right? If you're not feeling good on your pocketbook, you're not going to go out there and make your largest financial purchase of your life and buy a house. And so that's what we're seeing right now is people start to back off. They're doing mortgage applications, but they don't feel like it's the right time to buy. They see what the monthly payment's going to be, and they're terrified that they're going to either lose their job or they're not going to be able to make that payment at some point and lose their house. So they're just saying, hey, you know what? I'm actually just going to rent. My landlord just let me negotiate with them. They're offering free rent at these luxury apartment complexes that are completely overbuilt. And they're changing the way that they're just staying as renters. And so you have to ask yourself, who is the next buyer that's going to buy next year in this type of more fear type environment? I don't know who it is. And that's why I think that prices will come down. And then when prices come down, people will step in because they'll feel a little bit more confident. So how much will prices come down? Again, this is looking backwards, but everything is so regional and micro. It's really hard to even compare Florida to any other state other than Texas, basically, because we had a lot of the same things happen. We had the institutional investors come in and buy a bunch of single family rentals. We saw a lot of relocations during this time period from high net worth areas and just brought all this wealth to the area, and they gobbled up a ton of real estate, and the builders completely overbuilt. So we saw those three things happen, and it caused this boom in these specific markets. And these specific markets are now the ones that are going exhaling. They're slowing a lot faster than these other markets. So you can see that in this home price shifts in the 50 largest metro area housing markets. And this is pulled from the Lance Lambert House Price Tracker. So you can see down here, Jacksonville, we're down 3.2% over the last 12 months, and it's down 7% since the peak. I like to say the peak is October 2022. That's for our market where we're seeing it. But look, you can even see some areas in Connecticut and in the Northeast that are actually starting to move up, like they've gone up since 2022. So it's simply a matter of supply and demand. In the Northeast, they don't have the supply issues necessarily that we have here in the South with the overbuilding from the new construction. And they did not have the speculation for those years in the relocations that we had come in and just push up prices and push the locals out. Now they're starting to experience some acceleration. So every area is different. And that's why I hear everybody arguing on the news, on X. If you want to follow me on X, it's at John Brooks. But you can see that everybody's just arguing with everybody all the time based on what they see outside of their window when they drive around. If you drive around Jacksonville, you're going to see the same things that I'm saying. If you're driving around in Connecticut, in Hartford, you're going to say things are great. The real estate market's fantastic. So it just depends on where you are, and that's why we really want to be specific when we're talking about real estate. But looking ahead, just generally, pending home sales have fallen 6%, the biggest drop in nearly a year. So we're seeing that locally as well. We're down 30% for pendings versus this time last year in the month of November. And that's a really big red flag for next year. Again, it's the inventory. And we're seeing not only that, but back on markets, we're seeing a cancellation rate that's more than 15 to 20% in some cases, where the deal doesn't go through, the house comes back on market, and the seller is upset. And then they actually pull the listing and are hoping that next year is going to be even better. And so I don't think it's going to be better. I think prices will come down. If you're a seller listening to this, highly recommend you just get realistic on the price right away if you truly need to sell and get rid of the property, if you need to sell in the next year or two, because I do not see a situation where prices will continue to move up without massive, massive government intervention into the housing market, which I just don't think makes sense at this point in the market cycle. And just understand the micro aspect of it is that the change in the non-farm payrolls year over year depends on where you are as well. There's certain areas that are doing well, and then there's other areas that aren't doing so well. But the areas not doing well is starting to spread across. You can obviously see that areas of Florida are not doing as well from an employment perspective. But every market, again, is hyper micro, and that's why you need to dig into each market individually. One thing I want to talk to you about really quickly is Lennar. The home builders are definitely a red flag right now of what's going on. You can see their stock prices are starting to tank. Homebuilder Lennar cut average home prices by 10% last quarter, one quarter, as buyers pulled back amid affordability pressures and economic worries. And they're offering, rate buy downs to the 3s and 4%. They're cutting prices. They're giving free upgrades, anything to get rid of this glut of inventory that they had to get the new buyers into these products so they can get them off of their books. So we're starting to see slash of prices, and this is where we believe we will see the majority of the pain moving forward in the real estate market, is these people who bought in late 2021 all the way to 2023, they bought at these peak prices here. And then new home prices net of incentives are down 27% from the peak just in 3 years. It's incredible how much it's dropped. And this comes out from Lennar's information, their SEC filings that came out through, and Reventure put this chart together. So thanks, Nick, for doing that. But it is crazy. I mean, if you were buying in this period and you have phase one, phase two, phase three in a new construction area, that's going to be a major problem for you. Many of you watch the John Kaminsky YouTube video that I previously did, and he talks about, the folks who are in trouble, or FHA and VA, who bought in these new construction communities during this time period, and we're already starting to see the distress show up. Well, the government has kept the ability to basically foreclose on a home for the last 4 years. We have all these pent up foreclosures, and now we have this with prices coming down, all happening at the same time, probably going to show up Q2, Q3 of next year with those workout programs expiring and changing. And ultimately, this is going to play out pretty massively in certain areas around the country. We think Florida is going to be a hot spot for this, and any of those areas that, again, had those new construction builders build. We had them in migration slowed. The builders kept building even though migration slowed, and now we have an oversupply of this new construction that's competing against existing homes. And that's what sellers are really upset about. They have to compete against new and existing homes that have the rate buy down, and they're trying to find the next wave of buyers who are buying, who are generally 30 to 38 years old. And why would they buy an existing home if they could have a new construction home? Generally, I mean, obviously they're in better locations, usually existing homes. New construction, though, they have a specific look that they want. It's brand new. They don't have to worry about somebody else living in the house. But sellers around those communities are getting upset, and they're yanking their property off of the market. We call this rage quitting. This is from New York Post. Alarming number of listed homes are being pulled from the market. See which cities fared the worst. And Jacksonville is one of those areas where people are yanking their house off the market. They want to see if they can test it again next year and get a higher price, because they need the equity in their house now to be able to buy their next house. And so we're creating this lock-in effect where everybody's kind of just stuck where they're at. And that's why we're seeing these existing home sales also stay low. And of course, we were pitched this narrative for years that we have this housing shortage. There's no housing shortage. There's a shortage of affordable housing. So this is like, be clear. This comes from Fred. There's the most housing per capita in US history. There's something like 15 million vacant homes sitting right now. And the reality is, and even with the legal immigrants that are getting deported, we have like so many bad demographic issues coming up on the horizon with the silver tsunami. Sadly, 38 million boomers or older are going to pass in the next 20 years. Their houses are going to be inherited. Those inheritances are going to, about 70% of them, if they include a property, will be that property will come to sale. They'll have to renovate that house. They'll have to put it on the market. This is all supply that is coming down the pipeline. In addition to this pent up rage quitting supply for next year, it's going to continue to build. And you have to ask yourself, who is the next buyer for your marketplace? What are they earning? How much do they need to make? What jobs do they have? Why are they moving there? And this housing shortage that we pretended to have for so long, it was basically just a narrative for them to pitch you to go in and try to rush and pay the highest price possible. I'm convinced of that at this point because when we look across the country, there's only certain areas that had this shortage, and it's not a shortage of number of units. It's a shortage of units and an affordable price point that people can actually get on board with. So let's look at this. So areas that are falling the most are those areas that we saw have the largest boom. So Jacksonville, Orlando, Tampa, Dallas, Austin, San Antonio, Denver, Las Vegas, Phoenix, Sacramento, San Francisco, Portland. These are areas where there was a lot of speculation in home prices and they just went wild. And now we're actually seeing that prices are coming down. The greatest share of homes that lost value since last year, 83% of homes in Jacksonville, for example, and 4% of homes have lost value since their last sale. So they're purchased and now 4% of them are underwater. I expect that number to skyrocket in months coming ahead as prices truly go negative from here. Now, prices are coming down and they're spreading. This is from the housing downturn spreading from Zillow. This is from Zillow's indexes. It measures the percentage of counties with declining home values month over month. You can see that we're starting to spike here. 61% of counties are actually experiencing month over month declines at this point. I expect that units will go up next year as these prices continue to come down and sellers capitulate. I'd love to hear from you and hear what you see happening in your market. Comment below what market you're in and what your forecast is for next year. Are you seeing a lot of listings come on the market, or are you seeing the opposite where there's not a lot of inventory? So tell us where you are and what your experience is and what you think is going to happen for next year. As always, you can follow me on Substack at johnbrooks.substack.com. You can go check out my information below. And of course, now I'm on X as well if you'd like to follow me there in Threads. And I look forward to connecting with you in the new year. Have a awesome holiday, and we'll see you later.